everybody, to the second ever live version of the Charles Aris Industry Uncovered podcast. Industry Uncovered is a Charles Aris podcast series where we speak with experts in the manufacturing, industrial, and agribusiness sectors on emerging trends and exciting new technologies. My name is Casey Taves, and I serve alongside Eric in the Charles Aris agricultural practice. And today we're diving into AgTech, specifically AgTech investing. Over half of our client base has shifted to private equity firms in their portfolios in recent years, and we're seeing growing interest in the agribusiness sector. So we're excited to have panelists from all corners of the agriculture industry here today to explore trends, investing strategies, and the relationships that drive value at these crossroads. But before we dive in, I'd love to have our panelists introduce themselves. So if we could do Bundy, Eric, and then Mark.
Okay, I'm Bundy Lane. I'm a farmer in northeastern North Carolina, so near Virginia and near the coast. I raise row crop farm, peanuts, cotton, corn, soybeans, and some wheat occasionally. I also have a sow farm on contract with Smithfield Foods and a direct marketing Angus beef business.
Good morning, everyone. I'm Eric Spell. I'm one of the vice presidents here at Charles Aris Executive Search. I reside in North Carolina, and everything my team touches is related to agricultural food production, and I'm glad to be here today.
Well, good morning, everybody. I'm Mark Brooks, also in North Carolina and the Research Triangle Park. Began as a climate scientist for a long time, and then I was an ag tech entrepreneur, was on the investment team of Syngenta Ventures, and most recently was managing director and head of FMC Ventures, and have done somewhere around $70 or $80 million of venture capital transactions, all in the ag and food space globally, and been on the boards of directors, lots of companies in North America and South America, Europe, elsewhere. Good to be here.
Great. AJ, Scott, Kevin, can you round us out?
Good morning, AJ Woodyard. I am with Advanced Agrolytics in the role of agronomy lead. Advanced Agrolytics is a business that's been invested by private equity. So we have Payne Schwartz as our private equity investment group. And so I also have the opportunity to be a part of a farming operation. My family farms in East Central Illinois. We are primarily focused on corn and soybean production at our operation. So it's a pleasure to be here, and thanks for the opportunity.
Good morning, everyone. Scott Porter, I'm a managing director at Cascadia Capital. We are an investment bank. We partner with entrepreneurs and ag tech companies to help raise capital and to advise on mergers and acquisitions, so sales and potential acquisitions. I lead our firm's agribusiness and ag tech practice. Two quick things that differentiate us quite a bit in the market. The first is we have the largest ag and ag tech practice of any investment bank in the country. I say that with an asterisk. It doesn't take a lot to have that. There aren't many of us that truly are dedicated to the sector. Number two, I've learned over the years that it's a lot easier to teach banking to farmers than it is to teach farming to bankers. And practically speaking, about half of our team comes from some type of farming and ag background first, and we've trained the individuals in banking. So we've hired a lot of operators in the sector to be a part of our team. Nice to see everyone.
All right, and last, I am Kevin. I am a managing partner at Fulcrum Global Capital. We are an early stage venture capital fund that's based out of Kansas City, and we invest along the ag and food supply chain. We call ourselves the venture arm of the ag producer, and that's because we have a direct connection to the farm through our relationships with our investors. About 75% of our investors are all farmers, producers, mostly in the row crop space, and then heavy all throughout the animal production space. So good to be here.
Awesome. Thank you all. I'm really looking forward to the discussion just based on everybody's diverse backgrounds. So to get started, we're going to dive into three different segments. And the first is what our current ag tech investment landscape looks like right now. So our first question, and it's open to anyone, what are the most promising investment opportunities in ag tech and what makes them viable?
Maybe I'll quickly start, Casey. Thank you. at Cascadia, there are two themes or trends in particular that we are very excited about and have been spending quite a bit of time in. The first is robotics, automation, and artificial intelligence. Basically, we think of this as any technology that has to do with labor, with addressing labor availability or labor reduction. And then number two is anything in financial services or risk management. Why these two sectors? When we are out talking with the farmer, and we always think about technology as starting with the farmer first. What is the farmer looking for? When we hear from the farmer, the number 1, 2, or 3 problems that they're facing, it most often is labor, and then labor some more. So what we found is there are a variety of companies out there that are leveraging robotics, automation, artificial intelligence to reduce labor needs and to improve labor efficiency. The second thing that we often hear from farmers and pretty consistently is if there's one thing farmers don't like, it's paying taxes. And so we've seen a lot of companies pop up over the years in financial services as well as risk management to help address either tax savings or insurance and risk management. So 2 examples that I would add on the robotics, automation, artificial intelligence theme. Carbon Robotics is a great example of that. I think it's particularly interesting. So Carbon Robotics is a laser weeding company. I think it's particularly interesting that NVIDIA, one of the largest AI chip companies in the world, made an investment into Carbon Robotics. And at the time that they made that investment, they said that Carbon was one of the best real world applications of artificial intelligence that they've come across in any industry. And that specifically happened to be within agribusiness. Within financial services and risk management, there's a company called Boa Safra. What they do is help companies who effectively reduce their taxes. They go in and they value the nutrient rights under the ground or in the soil, and you can effectively step that up and depreciate that down and save on taxes. And we've seen both of those companies scale dramatically for the primary reason that they are addressing, in my opinion, some pain points that the farmers are having.
Maybe I'll add a few at least from our investor standpoint. I'd also, and I totally agree with Scott. I'd also agree I'd say any new modes of action. I think anything that's starting to address some of the resistant issues that I think we're seeing, I think is of interest specifically to the strategics. I think biologicals remains an interesting area. I think there's quite a bit of work that still needs to be done there in terms of consistency, in terms of efficacy, and getting the cogs right. I think along that robotics automation arm, sort of that precision application space, I think anything there that's reducing the amount of chemicals we have to apply, I think is going to remain interesting. And then this one will be broad, you hear it everywhere, but I'd say any real use cases where AI is making sort of production more efficient, I think are going to continue to get traction as well.
And I'll tackle on a few comments to it. So I agree with everything Scott and Kevin just said. That's I don't think there's any surprises to what these guys offer, and I fully subscribe to it. Labor is always going to be a thing for growers. New modes of action always going to be a thing, right? Especially with the changes in climate and pest resistance issues and such. And the strategics, many of the strategics have decent pipelines, I think, for new molecules or new traits, but they're not particularly thick pipelines, right? And so I think the strategics are increasingly beginning to look more at the startup ecosystem to find those new modes of action. And I think that bodes well for investors and bodes well for startup companies. But I'll add some more flavor to this. I think three additional things I'll add to it. One would be data interoperability. Right, so growers are drowning in data, and I'm sure that Bundy or AJ could talk about this from their perspective as well. And a lot of the data that's generated, a lot of the data that growers have access to it's not interoperable. It's hard to make sense of all the stuff, right? It's hard to translate the data into guidance or action. So that's a big opportunity space right now, I think, in AgTech. The second one I would offer would be the global south, right? So a lot of, I mean, there's no denying that the U.S., North America, is the place, right, in terms of dollars and in terms of the volume of startup companies in ag. But there's a lot of cool stuff happening in Europe, a lot of cool stuff happening in Brazil, Argentina, Chile. Africa is like this completely blank slate of opportunity. And these kind of global South regions are disproportionately exposed to climate variability, climate change, and the impacts of that. And I think there's a big opportunity for those kind of regions as well. And then the third thing I would offer, and this might be a little bit different or slightly provocative, but that's what I do. The third thing I would offer is to think a bit more broadly about what we mean by AgTech, right? And so traditionally we thought about labor and chemistries and traits and all the stuff we've been talking about for 30 years. But I think there's a lot of opportunity now to sort of bleed ag into energy, bleed ag into these other kind of adjacent disciplines where the science can be very applicable, right, from one to the other. And so I think that's also a big opportunity for entrepreneurs, but also for investors to find bigger exits than we've been seeing for the last 15 or so years.
That's
Bundy,
a great.
sorry, Casey, one quick thing. Bundy, just articulate the comment that you made earlier this morning around South productivity efficiency from 25 years ago to today.
Sure. When I met Eric, was right out of college, and at that time, so it's been 25, 30 years roughly. In that time frame, my sow farm, for example, we've gone from what was good production levels at those times were 20 pigs per sow per year. And we are now doing 30 pigs per sow per year. And I was telling Eric that, what's really cool about that is it took 6 truckloads of feed to feed my sow farm when I built it 30 years ago. It still takes every week, 6 truckloads every week. It takes 6 truckloads every week now. So we've not increased our feed consumption at all, but we've gone from 20 pigs per sow per year to 30 pigs per sow per year in that time frame. And I didn't know. I was asking Eric, did he ever think that'd be possible when we started? I don't know that anybody really thought that number was possible, but the more information we can crunch, and the better we can faster we can identify the right animals to keep and on the farm and breed and reproduce is key.
That's a great point. And no, I was just going to make a comment back to Mark when he was talking about just the definition of AgTech. I feel like that's ever evolving and something that, will continue to evolve. So that was a great point.
One more thing along those
Sure.
lines. One thing that I think we left out was around animal agriculture. The biggest impact that we have in animal agriculture is disease transmission. And we look at the way that impacted the egg industry this year with bird flu traveling around around the world, and then the African swine flu and how that's impacted the pig industry over the last several years globally. Those are huge impacts to the industry, to animal agriculture, and we certainly got to stay on top of that. And I don't know, it's not necessarily all vaccine related as much as it is also related to products moving around the world and better identification of those diseases sooner and containing those.
From an investor or investment perspective and capital markets perspective, animal ag tech is one area that we at Cascadia are very excited about. In particular, we've seen for tech companies fairly strong adoption by the producers themselves, and in many cases stronger than what we see on row crops. A part of the reason why, in our opinion, is the animal sector overall is much more consolidated. The path to commercialization, the path to market, the path to scaling tends to be much easier if you have a technology that works, as opposed to the level of fragmentation that you can have in row crops or permanent crops even. It just becomes much harder and more difficult to commercialize.
Yeah, I would say animal is an area that we've always been invested in. We have several investments in that space. I will tell you, from a pure investment, return on investment sort of perspective, animal is a little bit challenging, or it has been. We have not, I almost equate it to where ag was, call it 10 sort of years ago. We don't have as much strategic support as one would like to see. Haven't seen a lot of the bigger exits that would allow you to feel comfortable making early stage investments. And we even start to break down the different animal species, right? And so when you get the highly consolidated areas, when you think sort of poultry and swine, those are a little bit more difficult than sort of bovine is. And so we continue to look for everything that Bundy was really referencing, early detection kind of stuff. Can you get towards therapeutics versus vaccines and some other areas? But it is a challenging space where we need more investment dollars to come in, more early stage investors, more sort of strategic investors, if you will, and then obviously some more exit activity on that side as well.
Can I just insert one comment? So great points about the animal ag, and I'm glad y'all brought that up. Scott mentioned something. I think it was Scott mentioned something a few minutes ago about financial technology or credit or lending or something like that. And I don't want that to get lost, because that is I think that is a massive opportunity globally for ag. I mean, it's agriculture is one of the few industries where the grower or the customer, has to often take a loan to get the inputs, and then they are at risk really for the entire growing season to pay that loan back. And then there's all kinds of timing considerations of when you go to market with your output so that you can get the best price to pay down the loan. There's a lot of challenges. There's a lot of friction, a lot of economic friction, I think, there for growers. And many of the distributors and larger ag input companies, they often have no choice but to carry those receivables on their balance sheet for the duration of the season. And that's, doing these loans is not a core competency of these companies. And so that also creates economic friction. And this is true for North America, South America, this is true for everywhere in the world pretty much. And so I think in some parts of the world, not as much in the US, but there is an explosion of fintech companies in ag. And I think that is a very attractive space for investors. Because it's solving a problem for multiple stakeholders in the value chain. It can also be a really useful tool for driving behavior change, right? So encouraging the adoption of this product versus that product, for example, or de-risking things for the grower to adopt new technologies. And it's also is a way to just remove the economic friction. And so I think tremendous opportunity, and it also attracts different kinds of investors or super capital efficient businesses, typically larger exit multiples than you would see for a hard asset company. So that's a really good space.
And I think it's a space that many of the customers, the farmers, already know. Many of them are already leveraging some type of financial product or loan, are already leveraging some type of risk management or insurance product, are already leveraging some type of accounting or tax product. So the opportunity to come in, take something that's known, but bring innovation and technology to it to improve on that product set is immediately understood. And I think adoption curve tends to be much stronger in those areas.
Yeah, these are some really great points. And we have attendees from inside and outside of ag here today. So I think it would be interesting to talk a little bit about the life cycle of these ag tech investments, because they do differ from other industries. So if you don't mind just talking a minute about that.
Well, that's a big question, right? So it is, I think it's at a high level, I think it's a surprise to investors who are new to ag. And I also think it's the ire of some investors who have been in ag for a long time. And, the reality is that many ag tech investments or many ag tech companies, they take a long time to get to maturity, to get to market, to ramp up their sales. The adoption curve is relatively slow compared to consumer goods or whatever, because you've got the seasonality, you've got regulatory hurdles to go through in the case of molecules or traits. It's just a slower moving space. It's no less important. It just moves slower to get to maturity and to get to an exit, to find that liquidity event. There haven't been many exits in ag tech, compared to other industries or sectors. I'm thinking like human therapeutics or drug discovery or even, consumer spaces. Ag tech is one of the kind of at the bottom of the list, I guess, in terms of the pace of exits and even the multiples, the valuations or the EVs of these exits. And so it doesn't make it less important. It doesn't make it, less impactful of a space. It's just the reality of it, I think. So valuations tend to be lower typically in ag than other places. They tend to take longer, to get to that finish line than other places. But I think it's like we said earlier, Casey, I think it's an evolving, like what we mean by this category is evolving. And so I still think there's a lot of upside in ag.
I agree with Mark in terms of the sales cycle, taking a biologicals company as an example. It's going to take years for a biologicals company to, first off, develop the product. And then you're going through trials, you're going through registration. It can take a significant amount of time before you even start thinking about commercialization, true commercialization. Once that commercialization happens, then you have to go out and sell to the farmer. And oftentimes a farmer is not going to take a new product and apply it to their entire crop, their entire field. They're going to put it on maybe a test plot first. If it works, then maybe that next season they're going to put it on 5 or 10% of their farm. If it works, then maybe it goes to 25% and then maybe everything. And so it can take multiple years to truly penetrate a product with a single customer. Now, I think that is a unique dynamic of the ag sector sales cycle that we need to be mindful of. One pushback, though, that I would have is, I think the long sales cycle of AgTech gets thrown around quite often. And sometimes we conflate what I think has happened in the industry, which is sometimes I think in the industry we've developed or put forth technologies that the farmer just doesn't value or care to adopt. And we say, well, it's not growing because it's a long sales cycle. I think we need to separate and bifurcate those two, because I have seen plenty of companies, and they're private, so I won't name names, that have scaled to 200 million, 300 million of revenue in just 3-4 years. And so I would argue that if you are truly listening to the farmer, what they're looking for, what they're asking for, and develop a technology that works, you can truly scale very quickly and rapidly in this market, because it is a massive market with significant potential. And so I want to be cautious of throwing the long sales cycle and out there. On one hand, yes, it's true, particularly for something that's very science driven, like biologicals. But on another hand, I think sometimes we've put forth products that the farmers aren't asking for or don't work to the market and say it's not growing because of the long sales cycle.
That's well said. Yeah.
Yes, very well said.
I
think. Oh, go ahead, Eric.
No, I was just going to make one other comment.
Okay.
One of the challenges that, and I agree with everything Scott just said, but one of the challenges of things taking a bit longer in ag is that for founders is being very judicious with the capital that they raise. Unlike traditional VC, which tells you go raise as much as you can at the biggest valuation, build it, and they will sort of come. That model, I think, struggles in ag. I think you've got to raise the capital that you need, and you've got to hit a lot of milestone points before you go out and you raise additional capital. So because it takes longer, the number one expense on all of these folks' cash flow statements is personnel. And so if you build up a team too big, too early, and it takes longer to get commercial, someone's going to have to keep investing in that and paying for that. And it just becomes harder and harder the longer it takes. So we always push our founders, raise the capital you need, but be very judicious about how you sort of spend that, knowing that you could find yourself in a longer sort of cycle before you get to commercialization and ultimately liquidity. So be careful of that.
Mm-hmm.
I'd be curious to hear, from Bundy and AJ in particular. I think one of the challenges we often have in the ag tech ecosystem is we don't listen to the farmer first and foremost. When you think about the sales cycle, Bundy, AJ, how do you all think about it?
AJ?
Yeah, I mean, it's so I think a lot of the points that have been made are really well articulated in terms of being someone who sits both in the farmer seat and working closely with farmers, there's a lot that you get inundated with, and it's not coming from the basic manufacturers all the time that everybody kind of knows and trusts. So it's coming from resources that and places that maybe creates a little bit of skepticism out of the gate. And then I think, Scott, maybe you made the point on the amount of time it takes to get confidence in a grower in a technology, and that's real. And I think part of the challenge is where do you go to get unbiased perspective or confidence, because you can expend a lot of your own time and resources that you need to be devoting to labor and the financials and all those other pieces and trying to evaluate and understand products on your farm, and you don't even have the expertise all the time in that area to do it. Unfortunately, I would say, the university system is not what it was probably 20 to 25 years ago. And so that's not necessarily the resource that we've got today either. So it's how do you as a grower evaluate products that are in the market and get confidence to be able to say, hey, if this is a technology that will differentiate my operation, which is what we're all looking for. We're looking to improve efficiency or improve ROI on our operation. How do I get to that answer quickly and confidently? Because otherwise I'm wasting a lot of resources and my own time and money trying to get to those answers. To me, that's a big struggle and challenge.
Hey, Jay, you made an interesting comment. Bundy was shaking his head. Just real quick for the audience understanding, what do you mean universities aren't what they were 30 years ago?
Just when you look at the resources, that are there and available, and the personnel that's there and available, it's not as robust. And then arguably in terms of being able to evaluate new technologies and, being on top of what's coming out in the market and being a resource that's sometimes I think the perception from myself of the university is more, how do they save us to prosperity versus how do we look at new technology and how do we differentiate our operations? So I think maybe it's been a step behind what it may have been, a few decades ago.
Bundy, do you have anything real quick? I know Casey wants to move us to a different question here very quickly, but
yeah,
go ahead.
One thing on the sales cycle, selling stuff to row crop farmers, for example, you get once a year. That product that you're trying to sell likely is a one application product or maybe two application product in a year if it's an input of some sort. And so you get once a year, one opportunity every year, every 12 months to sell that to a farmer. And if you miss that, you're going to be waiting 12 more months to try to convince him to use it next year. And then on the university's comment, I agree 100%. The university used to be, your extension agents. They were the leaders in the agricultural industry, and they were the ones promoting technology and getting technology out to the farmers. I think now it's actually the reverse of that. From what I can tell, they go around and see what farmers are doing and then try to take some good ideas and spread those around, but they're not the ones leading the pack like they were at one time. It's just, I don't know if it's a function of the universities or hiring. If private companies are hiring the better people and taking them away from the universities, or really why that is what it is. But the information they present us is not what it used to be.
Absolutely. This is actually a really good segue into our second segment, which is about bridging investors and farmers. So Bundy and AJ, I direct this first question to you to kind of keep the conversation going. But what makes farmers and industry stakeholders wary of private equity involvement in the first place?
From my standpoint, it would be lack of knowledge of how private equity investing works. And as a whole, I wouldn't say, from my farming standpoint, that I have a lack of access to capital is really not what holds me back from growing. There are other growth constraints that are probably more important. I feel like if I have a good business model, I can build my farming operation with access to current capital. It's usually other aspects, including regulations, that are holding us back as much as anything. But lack of knowledge of what private equity does is probably as big as any.
Yeah, and I would reiterate that first. I think there's just in our industry, and my dad's 71 years old, and I don't think he could tell you what private equity is. There's a lack of general knowledge in the category, but also agriculture is such a relationship driven business still. I mean, it's still about the people that you're working with, and within the companies, do their missions and their goals align to, say, maybe the way I think about, my mission and my operation and what I'm trying to accomplish. And so I think sometimes maybe there's potentially, there could be some concern around what's the longevity of an investment type business. It's not a basic manufacturer that's been around for 150 years. Are the people that I'm getting to know and acquainted to, are they going to be around and a part of that for me in the long run? And is the mission of that company going to stay the same as it, say, maybe transitions into a different phase of its life cycle in the investment process? And so I think there could be also, just because of the general relationship nature of our business, some concern with the investment side just around the people and the longevity.
So I've maybe got a real life example that may help, specifically because we've raised 2 funds now, and a little over 100 million assets under management, and about 75% of that are folks like Bundy and AJ, actual farmers, they're producers. And AJ is 100% right. Very trusted group of folks. And what we have found is they really invested in us for a couple of reasons. One was they wanted diversification, right? So they wanted potential other income streams from the operating entity itself, from the farm. But the biggest reason was they saw us as sort of a group that could bring them vetted early emerging technology, so that they don't have to do what AJ was talking about, spend their own time, if you will, trying to vet from sort of untrusted resources what may or may not make sense. And so the last part is we do what we call these producer panels on a quarterly basis. We get all our investors together. And so collectively, they make up about 30 million acres of row crops annually and millions of animals. We get all of them together, and we bring in on a quarterly basis about 8 or 10 different companies that are spread between crop technologies and these automation, robotics, et cetera. And we're not invested in any of them at that point in time. All we're trying to do is expose them to technologies we think are interesting. And it's sort of a win-win across the board. The folks like AJ get exposed to some technologies. They also get to raise their hand and say, hey, I'm interested in that one. Can you connect me to that one? Because it may actually make me more efficient on my farm. The early stage companies are excited because they're getting a direct connection to their end customer while they're still developing their product, and they're getting input on what needs to happen. And then from an investment perspective, we get to sit back and listen to this conversation, and we learn quite a bit about, in this space, what needs to actually exist for a technology to actually be successful. So completely agree with everything that Bundy and AJ said. And I think that's partially why we've been successful raising money from farmers. It wasn't because of our pitch necessarily. It was, but we got a good group of farmers. They went out, and the next time we pitched them, they brought 10 of their friends. And the next time they came out, they brought 10 of their friends. So we look up and we've got, a whole handful of folks that give us incredible insight every time we look at an opportunity.
Great. And Scott, maybe a question for you is, do you have any advice for those in VC that don't know about agriculture? How should they go about and learn?
Yeah, first and foremost, I think you need to go direct to the customer, really understand what they're looking for and trying to achieve, trying to accomplish. To answer the earlier question, I do think there's a misnomer about private equity a little bit. I've found there tends to be this broad view of any type of investor or private equity. The way they make a return or generate returns, they come in, they slash headcount, they reduce expenses and generate a return. That's kind of old school private equity investing. That's not really what we see today. Today, what we see most investors is, how can we bring capital and resources to grow your business in a big way? And I think that is still a view of private equity that we're trying to address and change in the industry, because it's not what we often see with the investors that we work with. That being said, I do think there is an inherent part of the trust is there can be an inherent misalignment from a timeline perspective. As we've talked about, developing these technologies, getting to market to the farmer can with a technology can take a considerable amount of time. The reality is many financial investors, whether VC or private equity, are on a finite timeline to invest in a business and realize and generate some return. That misalignment of that potential misalignment of timing can create challenges and within the industry. I can think of one situation, again, not naming names. I can think of one situation where one of my clients was in a board meeting and an investor stepped in and said, "Okay, this is all great," but they use the phrase, "How do we put the cow on the moon?" Right? They're really trying to push entrepreneurs to get a technology out to market very quickly, sometimes before it's ready. And when you do that, you can sometimes burn your relationship with the farmer, hurt the trust of the farmer by over-promising and under-delivering, or trying to get a technology out there that goes from first to third instead of going from first to second, second to third, and having something that truly works and expanding and growing and improving on that from there. So I think that potential push or misalignment of timing has the risk of creating a trust issue in the industry at times.
And if I could piggyback on that point, and I agree with everything Scott just said, thinking about this from the entrepreneur's perspective, I always tell entrepreneurs, whether they want to hear it or not, I always tell them, look, pick your investors carefully, because there's a bunch of investors, a lot of capital available out there, but you want to build a capital stack, a cap table, and a board of directors that will actually help you grow and think strategically and get access to the right people, the right networks, the right technologies, the right partners. And so, any investor can bring dollars to a startup company, but the best investors are the ones who will bring dollars and some additional layer or layers of strategic value. And those usually come from investors or funds that have some expertise in some aspect of ag or whatever the technology is that you're doing. And I think that's another way, by having that boardroom full of helpful people who are going to help you drive forward and not short circuit your progress by forcing you to commercialize prematurely. That's another way I think that entrepreneurs have a big role in driving that trust and transparency with growers also.
That's great. So Mark, this is actually a question directed to you. I want you to talk to us a little bit about impact investing. So we've seen it be a popular strategy for PE firms entering AgTech. So what makes AgTech a good fit for impact investing?
It's a good question. So I think AgTech is actually like one of the best proxies for impact investing. I mean, I would argue that almost every, maybe even every AgTech investment opportunity or legitimate startup company, I could argue there's an impact lens to that, because just the number of acres, the impact that agriculture has on planetary health and food security and human health outcomes. I have a hard time finding another sector in my brain that is more impactful than ag tech would be. And so, what makes it attractive is kind of all of that stuff. And so I think every ag tech company, I would say, is related to impact.
I apologize in advance, I've become a bit jaded at times as it relates to impact and sustainability, just because of how loosely it gets thrown around. From my view, I agree with everything Mark said. There are few better industries in the world to make an impact than the agricultural sector. I think when I think about sustainability, we sometimes think about sustainability as environmental impact and only that. I think of sustainability as the environmental impact, but also sustainability with kind of a capital S dollar sign. It needs to be sustainable from an economics perspective. And one of the challenges that that I think one of the areas the sector has missed in the past is a technology that's come to market that's sustainable from an environmental impact perspective has garnered a lot of interest, and that interest has come at the expense of really focusing on the sustainability from a dollar sign perspective. Do the unit economics work both for the technology and the company, but also for the farmer? Sustainability for the sake of sustainability, in my opinion, is not going to be adopted by the farmer. It needs to be twofold: sustainability that from an environmental perspective that the farmer wants to adopt, but also sustainable from a dollar sign perspective where the unit economics work both for the farmer and for the company, the entrepreneur, the tech provider. And I think sometimes we overlook that second one because of the bubble that we are in from an environmental investing perspective.
Yeah, I mean, it's not going to be sustainable if it's not financially successful, because it's not going to be around long enough to do what it needs to do.
Yeah.
Well said. Well said. We're going to move on to the third segment, which is talent and human capital. Eric, I want you to start off with this question. We've obviously worked with quite a few private equity firms, and a lot of those that don't necessarily have a history in ag. So what do you think private equity firms could do better in terms of recruiting top talent when they don't have that ag background?
Yeah, it's a good point. Oftentimes, and listen, most professionals understand the term equity. And when private equity firms are recruiting top tier talent from some of the big animal health companies, or maybe from the large crop protection companies, we won't name the names, but most everybody would know what comes to mind. I think sometimes two things happen. One thing is private equity team principals and partners underestimate the long-term incentives that people at legacy crop protection or animal health companies or what have you, they have. They also don't understand why the desired candidates don't necessarily run to get excited about equity in the stake of the business. And sometimes that long-term incentive with some of these legacy companies, if they've been there 25 years, could almost equate to what the private equity or the portfolio is offering the candidate. Another thing that we need to realize is in recent years, whether it's in the biological space, whether it's in animal health, there have been a lot of snake oils that have been brought to the industry. And these candidates, C-suite candidates, have seen their peers run to these opportunities because of the equity. And all of a sudden, these candidates are a victim of lack of funding, over evaluations, and they find themselves becoming floaters. And these candidates, we've seen, well, I've talked to some of my peers that have left the team and run to one of these opportunities, and they don't want to be one of them. And so those are some things that I think the last thing I'd say is private equity may need to get a little more creative in what the incentives look like to bring in the desired talent. We just don't need to rely on the equity only. Again, true agriculturalists are relationship driven, and they're very proud, and they want to make sure that they don't tarnish their resume on a mistake.
Absolutely. Kevin, I want to direct this question to you. What challenges do you see in recruiting portfolio level talent?
I think the biggest challenge is sort of getting to where it was, what Eric was talking about is we invest typically at sort of Series A, so a little bit beyond, let's call it proof of concept. And depending on what type of company it is, a lot of times you have a founder that is very well versed in that specific technology, whether they're a scientist or whether they're sort of on the automation AI side. And as these companies begin to get traction, at least the way we think about it, that's when we really think about groups like, Charles Aris and others who can help identify some of those folks that Eric was talking about that have this 20, 30-year sort of experience in terms of helping the company to start to scale to a specific point. I mean, everything we've talked about it's human driven, it's networks, it's people driven. And when you get people who have been in this industry for a number of years and have a number of relationships, that can be valuable if you bring the right person in or the right group of people in at the right time in the company, when the company actually has something that's valuable, ready to be adopted. And so we typically look to bring people into our portfolio companies when we are well beyond proof of concept, when we have something that actually works, we're ready to commercialize, or we're already initially commercial, and there's been some sort of response from the market that there's value in what we have. And now it's about how fast can we go from 0 to 100. That's typically where we look to bring in some higher level talent that has relationships and has experience, whether they've been running business units for big crop protection companies or animal ag companies or whatever they may be.
For sure. And Eric, again, from your standpoint, can you just share maybe some ideas on how ag tech companies, aside from maybe the equity opportunity, could compete for top tier talent in a competitive market?
I think maybe sharing some successes with the other portfolios that they've brought to market and had success with. I think also maybe respecting the fact that the top tier candidates are going to, even though there's that equity component there, in their mind, they sort of want to know what's next after an exit. They're going to respect the fact that in 3 to 5 years or 7 years, the private equity is looking for a successful exit. But more so than candidates outside of agriculture, these top tier candidates, particularly if they're in sort of their prime of their career, they're wanting to see, okay, what may be next for me? And so if the private equity firm can just respect that and have the conversation that, well, you're getting your equity, it's up to you what you do next. I think if the private equity could be a little patient and say, hey, here's what we see some options may look like for you after an exit is complete. They want to have those conversations a little more than non-ag industry professionals.
Eric, that's a really good point. We actually we brought an individual in one of our companies that had been in industry for 25 years. He was very successful at getting the company to exit, and he was trying to figure out what's next. And we've now brought that individual into 3 other of our portfolio in different capacities. And so that's providing that picture for, in this case, that gentleman who wasn't ready to be done, but saw himself having sort of 5 or 10 more years left, I think has been very valuable to us because of just the experience he's gone through, and for him to be able to be involved at the level he wants to be involved now that he's had the liquidity event with other opportunities.
Some great example, and thank you for the input there, Eric. So we have about 10 minutes left, and so we want to make some time. We have a couple questions from the audience. And the first one is, what is the appetite of investors in aquaponics, and how can a company address mitigation of risks to make themselves more attractive? So kind of 2 parts there.
I could maybe take a stab at the first part. I think the first part of the question was CEA/aquaponics. I haven't spent as much time in aquaponics, but in CEA, my high level read of the space is you have a variety of technologies within CEA and indoor ag. But you had one specific space in vertical farming that I think hit a bubble, burst, and I've seen a lot of financials of vertical farming companies. I've never seen one, to my knowledge, anecdotally, that has had positive unit economics. And the vertical farming space blew up, in my opinion, in a big way, and that kind of tainted the entire CEA industry. On the other hand, I have seen many tech-enabled greenhouses, particularly depending on the crop, be meaningfully and significantly profitable. And so I think we had a situation in the industry, the kind of a throwing the baby out with the bathwater type of situation in the industry, where the vertical farming space blew up and it limited investment in broader CEA. I remain very positive and optimistic on broader CEA. Obviously, it's very capital intensive, and a increase in interest rates can have a very significant impact as a result on that industry broadly. But at the end of the day, I've seen very strong unit economics and do believe CEA is a big part of our future and will come back in a big way broadly.
And I'll take a slightly different tack to it, not to disagree, but it's a different angle to the question. Look, I mean, I think controlled environment agriculture is, as Scott noted, very high CapEx. It's very hard to get the unit economics to work in places of the world where you can grow the same thing in a greenhouse or in a field for far, far cheaper. And so you're like, you can't compete with that. But I think CEA has a big role to play in food security, particularly in places like the GCC countries, the Middle East, where you really can't grow the stuff in the middle of the desert. And so I think I think there's opportunity for that kind of stuff, but it's dependent. I think largely dependent on geography, and just kind of the local ecosystems.
Geography and crop, I would add crop. The low value crops, it just, in my opinion, will never pencil in a meaningful way. It needs to be high value crops, in particular, more niche crops where the return that you can get off of those makes sense and can cover the CapEx that Mark mentioned.
Good question. Whoever asked that, thank you.
Yes, thank you. The second question is, what are you seeing in AgTech that's reducing the farmer operator's insurable risk, and whereby reducing the risk would decrease their insurance premium?
Yeah. So, I mean, I think there's the crop insurance products that you can get from USDA and other kind of organizations like that. I think I've seen some strategics offer kind of something equivalent to a crop insurance type of product as a way to de-risk the adoption of a new seed variety or biological product, for example. I think that's pretty cool. I've seen dozens of startup companies now, use remote sensing, satellite, all kinds of other kind of data layers to automate the validation of, losses or gains, and plug that into kind of the parametric insurance calculations to calculate premiums. And that done well, that can lower the premiums for grower and still achieve the same kind of, protection. So I think I don't see as much innovation there maybe as I think there ought to be, or as I would like for there to be, but it's definitely along the lines of that fintech kind of stuff we talked about earlier.
So I would add that, so part of my business that I do direct marketing, whether it's through a direct contract with Smithfield Foods where I raise wean pigs for them, and there is no government, no stock market involved in that marketing. That's an agreement between me as a producer and Smithfield Foods, and we make that agreement, and so it's profitable for both of us. And the same way with my beef side of my direct marketing, I can control the price of that end product that we're producing, and so I can guarantee a certain amount of profitability there as long as competition doesn't put me out. But where I really struggle in my farming operation is in maintaining profitability is with row crop agriculture, where what I'm selling is dependent on the stock market, which is manipulated by managed money and government regulatory intervention, whether it's directly related to what we're producing or it's trade negotiations that the government gets involved with other countries and how that impacts our cost. Those things, in my opinion, are huge obstacles. And anywhere that we can, as a farmer, I'll be honest, I've talked to my son about this, any part of my operation where I can get to a point where I don't depend on where I have a set market that I can set for my products, I'm way better off in the long run. Where I'm having to take a price is where I'm in trouble. Where I'm helping set my price, and where I can negotiate that price. For example, I raise a lot of my soybeans and corn go to a major chicken producer. I won't name their name, but they're in my area. They have a soybean processing mill near me, and they buy a lot of corn from me. Some of it goes to Smithfield, but most of it, Smithfield has to buy their stuff from them too, their soybean meals. But I'm a price taker there. And they, at times, because of where we're located, have a positive basis, net basis against the, marketed, stock market trades or stock market prices, or they may have a negative basis or positive basis, depends on their needs. But I think they would be better off long-term if they could talk to me before I even plant my crops and negotiate a price, and that I'm comfortable with, that they're comfortable with, that they're going to know roughly the volume of product they're going to get. And it would add a lot of stability to what we do. I negotiate, for example, my peanut crop. I sign a contract before I ever plant peanuts, so I know the price I'm going to get for my peanuts. I don't with other crops, and that's a problem.
Very good point.
Okay, tons of good. I love all the questions that are coming in. They're really good.
They're really good. We have time for two more. So the two I want to focus on, the first one is, how close is widespread adoption of automation that will make a meaningful reduction in labor requirements?
Look, I mean, how close is it? I don't think I'm qualified to put a year number to the answer. There are, and I've invested in some and have seen dozens and dozens of other startups that are doing, have solutions for this. But the thing is that they're all kind of crop dependent, right? So like you have a robotic or automation thing for this crop, but doesn't work on anything else. And that's the big challenge, I think, for scalability of this kind of technology. But it's also an opportunity, right, for entrepreneurs to figure it out.
Yeah, I'm like you, Mark. I can't put a year on anything. I think what we can say is in use cases where there's an ROI for the farmer, we know that they will look to adopt. I think I tend to gravitate a little bit more towards retrofit opportunities because they can use their existing equipment versus, hey, now you need to buy this branch over here that is, just as expensive as your tractor. For a particular use case. So I think the broader the use cases, specifically when I think about automation, and if there's retrofit, I think those have the cost is lower and the ability to adopt, I think, makes it a bit easier, giving the farmer a shorter window for sort of ROI.
For sure.
From a standpoint, trust me, if you look at where we live as a whole, as farmers out in rural America, we don't want more people. So we'll do anything we can to get rid of more employees. I mean, we don't want to have to deal with them. If you've ever employed people and been a manager of where you have to employ a lot of people of any business, the last thing you want is more employees. So we're adopting as fast as we know how. I
do think, most technology tends to be exponential, not linear. I do think that that automation will be more linear. I think we'll take baby steps over the next 10 to 15 years and gradually take more and more out of the system with more technology. The tech companies that have come and gone are the ones that try to take an exponential approach to it. The reality is, particularly for permanent crops, the variability in the field makes it very, very challenging. And I think we're quite a ways away from, particularly for automated harvesting in certain permanent crops, we're quite a ways away from that. I do think we will make improvements along the way that will gradually get us to a meaningful change.
Absolutely. I think the final question to round us out for today will be around a lot of the solutions discussed need real-time connectivity, which is challenging in the farming environment. So what does the panel think about this problem and solutions?
So you're absolutely right. I mean, in remote areas, I'm thinking like South America, for example, you literally do not have connectivity at all for the internet. So I think there's two kind of solution pathways that I see at least happening. One would be computing at the edge. So, I see a lot of this type of activity where you don't need to connect to the internet. You can do whatever computational analysis needs to happen at the edge or on the device itself as it's cruising through the field. That solves the problem. If you do have to have connectivity, I know that there are some startups now beginning to look at using Starlink or the equivalent to Starlink, right? So which kind of works almost everywhere. So I think the problem exists, yes, but I really think the problem about connectivity is getting smaller and smaller and smaller with each week.
Completely agree.
That's great and great questions. So thank you to those attendees that asked those questions. So that's all the time we have today. But as we wrap up, I just want to thank our panelists, participants, and organizers. And if you'd like to explore more on today's topics, check out the resources that we just put in the chat. And you can also reach out to Eric and myself directly by visiting the charlesaris.com website and navigating to the agricultural webpage. So thank you all, and we'll hopefully see you next time.
Thank you, Casey.
Thanks, everybody.